Hey folks, welcome again to the Heritage Wealth Planning YouTube channel. Today we're going to talk about Chapter 7 of my book, Strategic Money Planning, 8 Ways to Get Your Financial House in Order. And this chapter is titled, Do Not Rely on Your Employer for Your Life Insurance. And we're going to bring back the fictional characters of Brenda and Kevin, who we've been referring to a lot throughout the book and of course these YouTube channels. So remember, Brenda had a job at $50,000 a year, and then she got it cut back by 20% because the financial crisis of 2008 made all kinds of companies have cutbacks. So now Brenda is making $40,000 a year. So how much was her life insurance? Well, she had four times salary of life insurance at $50,000 a year, which meant she had $200,000 of life insurance. And she thought that'd be adequate simply because her mortgage was only $190,000 bucks. All right, so she's like, if I get killed, Kevin has enough to pay off the mortgage, has $10,000 extra, and he should be able to have that enough without the debt from the mortgage to find work, and they should be okay. Now, rightly or wrongly, that's not a bad assumption. But remember what happened to Brenda. She took a 20% pay cut, and so now four times salary is what? It's $160,000 of life insurance that she has. So is that enough? Well, the facts are she has $190,000 of mortgage, her and Kevin. So if she got killed, that life insurance wouldn't cover the debt. Now, on a side note, I do hear a lot when I'm working with clients, and again, I've been doing this for a long time, folks. I have enough through work because of my employer-sponsored plan. I said, what exactly do you have? I don't know, and a little bit sheepishly, and then we kind of dive into it. It turns out they have lots of AD&D, accidental death and dismemberment. And I said, well, do you know exactly what AD&D covers? Not really. Well, let me tell you, folks, it does not cover every death that you take. So if you had a disease or a sickness or something like that, which kills most people, AD&D won't kick in. And thus, you don't have any. It's not a true life insurance, AD&D. You don't have true life insurance if that's all you're relying on. And how do you know that? Well, we'll just look how cheap it is. AD&D is so doggone cheap. And the reason being, because it doesn't cover much. Now, I'm not saying don't have it, but let's not use that as our sole life insurance. So now let's go back to Brenda and Kevin. Remember, Kevin and Brenda could not afford that 20% salary that Brenda took. So she started looking for other work. And this time she found a new job. Yay! It's going to pay $50,000 a year. Yay! In a company that she really likes. So she was stoked to get started. The problem was when we went to sign up for benefits, turns out they did not offer life insurance as an employer-sponsored plan. All right, so she left her previous employer, left everything over there, goes to a new company, and has no life insurance as an employer benefit. So Brenda, seeing, as a very conservative lady, seeing the writing on the wall, says, yikes, if something happened to me, Kevin and the kids are going to be in a world of hurt because we have no liquidity. We have no cash account. We're just getting by just based on cash flow. If we were to lose income because I died, Kevin and the kids would be destitute. So let me go out and buy some life insurance just because I want to make sure they're covered in case something were to go wrong. Well, she goes to life insurance and they do some underwriting. And guess what? Turns out Brenda was taking medication for anxiety. Maybe there's an issue in the past. Who knows? But when the underwriting looked at her previous physician medical records, they found out that she was taking anxiety medication. The insurance company gets very, very nervous if you're taking anxiety medication. And so what do? They offered her a policy, but the premiums were not going to be very favorable to her. In fact, the premiums are going to be quite high. So Brenda in this case is stuck because she's like, oh man, we're just barely making ends meet as it is, even though I have this $50,000 a year job. But how can I afford this premium on this life insurance I need to make sure that if something were to happen to me, my husband and kids are covered? And that's the reason that you don't want to solely rely on your employer for life insurance. Because if you leave your job, what happens if you go to another firm and they don't offer life insurance? And on top of that, what happens if you can't get life insurance on your own anyway because of whatever issues there are? Now, Brenda let's just say she had another issue. Maybe the insurance company said, oh, no, you're, I don't know, heavy, or you smoke, or what. I mean, the list goes on and on and on, the reasons why the insurance company would say no to you for getting a policy. But if you have no employer work, cover life insurance, and you have no life insurance on your own, you don't have life insurance. And if you have debt, you need life insurance. Let's just get that cleared. If you have debt, folks, you need life insurance. There's just no other way around that. I don't care if you have term or permanent. We'll talk about that here in a second. But if you have debt, you need life insurance. Now, what I'd suggest is to don't be like me, and let me give you my example. So I was working comfortably at a firm for almost 10 years. Had a good amount of life insurance through my employer, because when I went to go get my own policy, it turns they didn't like my triglycerides, they didn't like my HDL was too low, my LDL was too high. And I have another video on ways to reduce your life insurance premiums. I was obese because I work out, so they didn't give me very favorable coverage either. So I said, man, come on, I'm not gonna take this policy when I'm in good shape. I mean, I do work out, I do like to walk, I don't smoke, I don't drink. But because the way insurance companies analyze things, BMI, body mass index, triglycerides, HDL, LDL cholesterol levels, we're still in the 1980s when it comes to analyzing risk to you for having a heart attack. So because of that, they didn't give me favorable terms. So when I left my employer, all my life insurance was through them, because it actually was a little bit cheaper and more convenient, frankly, to have it through them, my previous employer, than to get my own policy. But lo and behold, when I left, and there is something called portability. You can actually take your coverage you have from your employer and move it to your own private policy when you leave the company. But remember, what happens there is the rates are not going to be very favorable to you, because when you're part of a group policy, folks, a group insurance, be it healthcare or life insurance, simply means the sick are being subsidized by the healthy. Doesn't mean it's good or bad. It just means if you are healthy, you're paying the same premiums as someone who's not as healthy, and the premiums get evened out for the group as a whole. That's the way group policies work, rightly or wrongly. And so when you leave the coverage of your employer group policy, you're now going to get your private policy based on you as a group, and that rating there is called standard, which is the lower part of your life insurance underwriting table. Essentially means you smoke. Now, you might be an Iron Man. You might be in the best shape ever. You might do CrossFit every day. It doesn't matter, because the insurance company cannot take the risk of taking on a guy who's about to keel over because of heart failure, even if you're gonna pay many years into premium, because you're not gonna die anytime soon. They just cannot say, Josh, you're in pretty good shape. You're paying $50 a month. Joe, you're not in very good shape. You're going to die tomorrow. So Josh's $50 a month premium is going to pay for Joe's $250,000 life insurance. No insurance company can continue with that. So they're going to charge everybody equal, which means the sick get lowered premiums, the healthy get raised of premiums. It's just the way it is. Now, because of that, I said, well, I want to get my own policy. Well, guess what? I didn't have any life insurance because I dropped the policy that my previous employer offered because it's just too doggone expensive, while I was waiting to be underwritten from my new policy that I was going through. It's scary. I was driving back and forth through Chattanooga all the way up to Nashville once a week, back and forth. And I remember I had a blowout. One of my tires blew out on 85 North in the middle of a torrential downpour. I was coming back late at night. We had all kinds of rain, and I had to take these back roads with these big tractor trailers. I mean, it was scary. And I told myself, if I get killed, my wife and my 4 children, they're not going to be able to get by. We have way more debt than I had equity in the house, never mind savings. And that scared me to death. For 3 months, I was worried about that. I was worried sick. Now, finally, I was able to get approved by a company called Health IQ, because they actually see the benefits of someone doing CrossFit, someone working out, whatnot. They see that if your triglycerides are low, your LDL doesn't matter. That LDL is your bad cholesterol. Those days of worrying about LDL are gone. We still would like to see high HDL, but even that's not that big of a deal. It's really your triglycerides. And so once I started going on a low carb, higher fat diet, my triglycerides dropped like a brick in water. And the Health IQ company, realizing that my BMI, my body mass index, the reason I'm heavier relative to my 5'9" frame is because I do lift weights, and so they realize that. So they give me a wonderful rate. Now they make you jump through some hoops to make sure that you are truly in a workout person, as opposed to just saying that you are. But it's absolutely worth it. So now I have a lot of life insurance for cheap, but for that 3-month time I had nothing. And I mean, I will never forget that. That scared me to death. Don't let that be you. So the lesson is two things here. If you're relying on your employer for life insurance because you think you have ADD and that's enough, you're in the wrong. You are wrong. I'm just telling you, do not do that. ADD isn't true life insurance. If you're relying on your employer for life insurance and only gives you a certain amount times salary, well, if you have $300,000 of debt and you only have $50,000 of income and the max you can get is 4 times salary, you got a $100,000 gap there that if you got killed, I hope your heirs can make up somehow, either with cash, well, that's it, cash or some other life insurance policy that you have. Thirdly, get yourself a private policy outside your employer. What happens with employer-sponsored life insurance, folks, is that they're banded. Every 5 years, 40 to 44, 45 to 49, so on and so on. As you age, the premiums jump through the roof relative to what it was the previous band. So again, you got bands, 40 to 45, 45 to 49, 50 to 54. Each band you graduate to, you're talking 50, 60, 80, 200% increases in premium because the insurance company knows that the older you get, the more likely you are to keel over. That's just a fact. And they're going to charge you accordingly for that. Now, when you have a 30-year term, for instance, there is no band. You pay a flat rate for the 30 years you have the policy. And the insurance company has a contractual obligation to provide you coverage so long as you make the premiums. So once you get approved by the insurance company, they cannot renege on that policy. As long as you make the premiums, you have coverage. Another mistake I made, I had, I think, a 30-year, when I was 30 years old, I had a 30-year term policy through USAA for $500,000, for like, $20 a month or something like that. It was dirt cheap, my friends. And like a fool, I got rid of that. So now I'm 47 years old. I could have had $500,000 of life insurance costing me like a 30-year-old man for another 13 years. I could have had $500,000 of life insurance from 30 years old till I was 60, paying the premiums of how old I was when I initially took it out at 30 years old. Now, the same policy today for a 47-year-old man, not anywhere near what it was when I was 30 years old. So I can't tell you how many people say, well, I don't need life insurance. It's just me and my wife or whatever. I'm not getting married anytime soon. Man, if you're 30 or if you're young, get yourself a 20 or 30-year term policy. We're talking $15 a month if you're in pretty good shape. Yeah, that you just can't beat that, folks. Get yourself, so if you're 30, you get yourself a 30-year term policy. If you're 40, get yourself a 20-year term policy. If you're 50, a 10. You see where I'm going here? Get it so that way when you hit 60, when the kids are most likely out of the house, and you probably, hopefully, no longer have any debt, the policy expires and you probably don't need life insurance at that point. But get the insurance now. The younger and the healthier you are, the cheaper it's going to be. And I don't care if you're 30 and just newlywed. Get yourself a 30-year fixed life insurance to cover the scenarios like what happened to me when I left my employer and I had no insurance. What happens if I would have left my employer with no insurance and I wasn't able to get a private policy? What if my new employer, like we talked about Brenda, what if they didn't offer a private policy and I couldn't get it for whatever reason? Then we have no life insurance, but man, we could have a lot of debt. If I got killed on that one I-85 corridor up through Nashville, what happens to my family? Don't let that be you. You can't have that. So let me just share with you one thing, and then we'll close this up. I'm going to minimize myself. This is VGLI, and this is an example I want to show of group rates versus private rates. So here's the bands, and just look at this amount, $400,000, and you see the bands, 30 to 34, 35, 39, 40 to 44, and so on. So if you're 30 to 44, 34, and you have $400,000, your premiums are $40 a month. For anybody in the plan, anybody. VGLI is Veterans Group Life Insurance. It's a group plan for folks who separated from service from the military. They don't do any underwriting. I don't even think they consider if you smoke. So if you're right here and you smoke, it's $40 a month. If you're right here and you don't smoke, it's $40 a month. It's that simple. Now go down to here. Now let's see, we start here. So let's go 10 years. Now increases by, that's 80%. So now you're 40 years old, a factor, you only increased by 10 years. And now it's $68 a month. And again, if you don't smoke, $68 a month. If it does smoke, $68 a month. If you're a million pounds overweight, $68 a month. If you're, 5'9", 155, which apparently is where you're supposed to be, it's $68 a month. But watch this. Now, the next 5 years goes from $68 to that. That's a 35% increase, and then to that. That's over 100% increase from 40 to 50. But watch this. From 50 to 55, from 54 to 55, it goes to $268 a month on VGLI. So remember we talked about taking that 500, we'll just say 400,000, 400,000 year term policy, 30-year term at 30 years old, costs it's $20 a month. I actually did a quote on this when I was writing my book from USAA.com. We're literally talking 20, $25 a month for a $500,000 30-year term. Well, if you want your group rate, it's $40 a month, and it changes each and every year. If you would have got locked in a 30-year term, or even a 20-year term, or even a 10-year term, you're going to save a significant amount of money on your life insurance than you would if you got your group policy. And again, VGI, I'm just using that to show you how group policies work. Every group's going to have different rates, so don't hold this as gospel, but it just gives you an example of how much the bands increase every 5 years. Is mind-boggling. So don't be like me. Don't cancel a life insurance policy you took when you're young, because you're never going to see those rates again, most likely. Now, you maybe quit smoking and maybe you're in better shape. There's always a chance that you could refinance your life insurance for sure. I get that. But don't quit or cancel a policy before you get a new one in place. For the love of Mary, don't do that. Secondly, if you're relying on your employer and all you know about your insurance is AD&D, again, you're wrong. You got to find out more. What more do you have? Is it enough, if nothing else, to cover your debt? Rule of thumbs, cover your debt and maybe leave your heirs with a year or two of income. Yeah, you don't need $1 billion of life insurance, but you do need enough to cover your debt and maybe leave your heirs with some money. That way they can get by for the first year that you're gone while they're in sorrow state, and they got to find work too. Lastly, if you are getting separated from service and your new employer doesn't have policy, you got to get approved for a private policy. So don't wait like I did to see if you can't get underwritten for that private policy, because it might work against you. You might not be able to do it. Remember we talked about Brenda and myself included. What happens if you go to an employer and you can't get underwriting, you can't get coverage, and your new employer doesn't offer it? Then you have no life insurance, and that's a risk you don't want to take. So the moral of this story, get a private policy as young as you can, lock it in until you're about 60 years old or so, until you think the kids are out of the house and you have no debt. Parents, if you have a child who's 25 years old and they're not listening to you, man, just tell them, say, hey kid, I'm going to buy you a $250,000 30-year term policy because you're 25, you don't smoke. It's probably going to cost $10 a month. My goodness, just do it. So that way when they mature and they see what's going on in the real financial world, they'll have a policy at the ready that they don't have to worry about it as much, because you already got that taken care of. Lastly, and I've almost forgot about this. Let's say every now and again you like to have a smoke with the boys or something like that. You go play pool and you're smoking a cigarette. Folks, for the love of me, don't smoke cigarettes the night before you go get your underwriting for life insurance. Even if you don't smoke full time, just the fact that you only smoke that one cigarette, the nicotine's in your bloodstream. And when they do your blood work and urine sample, they're going to see you have nicotine, which means they're going to assume you smoke, which means your rates, if you even get approved, are going to be through the roof. I'm not telling you to lie to an insurance company, but if you don't smoke, other than every now and again you go out shooting pool with the boys and you have a smoke on the way into the bar, wait 30 days or so before you apply. And don't let that nicotine be in your bloodstream, because it's going to affect your premiums drastically. And on that note, when you're being underwritten, don't volunteer anything to the insurance company either. They'll ask you a question, answer yes, no, truthfully, but don't say anything else. It's on a need to know basis. They will ask you what they need to know, and if they don't need to know, they won't ask. So keep your mouth shut. Don't overindulge what they need to hear, because they might hear you say something that could come back to haunt you when it comes to underwriting. All right. Hope this is helpful. Review your life insurance, please, please, please. Your employer-sponsored life insurance and or your policy that you have on your own. And then put some comments down below. Any thoughts, questions they have on this. Always give me a thumbs up and always subscribe and hit that notification bell too to be made aware of further content that we produce here at the Heritage Wealth Planning YouTube channel. Look forward to seeing you next time. Thanks, guys.